A little over 3 weeks ago, voters from across the country headed to the polls or mailed in their ballots to determine who would lead our country forward over the next 4 years. While multiple seats were up for grabs in the House and Senate, most of Wall Street was focused on the race for the White House. Although not all aspects of legislation on Capitol Hill have bearing on the stock market, elected officials are responsible for shaping the fiscal policy that can aid or inhibit corporate growth. During the early morning hours of November 6, the Associated Press called the election for former President Donald Trump, who ultimately earned 312 electoral votes to 226 for Democratic Party presidential nominee Kamala Harris. Investors had plenty of reason to smile during Trump's first term in the Oval Office. From his inauguration on January 20, 2017 until President Joe Biden took office on January 20, 2021, Trump oversaw respective returns in the mature stock-driven Dow Jones Industrial Average, benchmark S&P 500, and innovation-fueled Nasdaq Composite of 57%, 70%, and 142%. Despite beating the odds and becoming only the second president to serve in non-consecutive terms, Grover Cleveland being the other, President-elect Donald Trump is set to make dubious stock market history when he takes office for his second term. No president has ever inherited a pricier stock market. Despite all three major stock indexes soaring after Election Day, President-elect Trump will be entering the Oval Office under extremely challenging circumstances. More specifically, no incoming president has ever inherited a stock market as pricey as the one we're looking at today. Admittedly, value is in the eye of the beholder, and what one investor finds attractive from a valuation standpoint may be the opposite for someone else. But according to one historically flawless valuation tool, there have only been a select few times since the early 1870s where the stock market has been this pricey. Most investors are likely familiar with the price-to-earnings (P/E) ratio, which divides a company's share price into its trailing 12-month earnings per share (EPS). The traditional P/E ratio can be a fine tool for quickly assessing relative value for mature stocks, but it's often lacking in the sense that it fails to factor in future growth potential and struggles during shock events. By comparison, the S&P 500 Shiller P/E ratio, which is also commonly known as the cyclically adjusted P/E ratio, or CAPE ratio, is based on average inflation-adjusted EPS from the previous 10 years. Examining 10 years' worth of earnings data smooths out the impact of shock events and leads to apples-to-apples valuation comparisons.